Breaker blocks are one of the most powerful ICT concepts, but only if you know how to use them. In this video, I'll break down 3 practical ways to trade breaker blocks.
So by now, some of you might already know what a breaker block is, especially if you've watched my previous videos. And if you haven't watched that video yet, I would strongly suggest watching it first, because this video builds on that concept. But let me still give you a quick and simple idea so everyone is on the same page. A breaker block is nothing complicated. A breaker block is simply an order block that gets displaced through. That's it. For example, suppose we have an order block on the chart. Now, instead of price respecting that order block, price moves through it with strong displacement. If a bullish order block gets displaced bearish, that order block is no longer valid as support. At that moment, it becomes a breaker block. The same logic works in the opposite direction as well. An order block that fails with displacement and flips its role becomes a breaker block. There is no special pattern, no indicator, and no advanced rule behind it. It is just an order block that gets inversed with clear displacement. Now let me show you an example on the chart so you can clearly see how a breaker block actually looks in real market conditions. For example, here you can see that we first have a bearish order block on the chart. This bearish order block is valid only as long as price stays below it and respects it. Up to this point, the order block is doing its job as expected. Now notice what happens next. A strong bullish candle forms and displaces through this bearish order block. Price does not show rejection, hesitation, or respect. It moves straight through the order block with strength. At the moment this bullish displacement happens, the bearish order block is invalidated. It no longer acts as resistance. Once an order block gets invalidated with clear displacement, it changes its role. That same area now becomes a breaker block. From this point onward, we no longer look at this level as bearish. Instead, when price comes back into this zone, we can now use it as a bullish confluence. This role flip is the entire concept behind breaker blocks. There is nothing complicated about it. An order block that fails with displacement becomes a breaker block, and we simply follow the new direction of price. Now I'm going to show you how to use breaker blocks in your trading. There are actually 3 different ways you can use a breaker block. It's completely up to you. You can use all of them together, or you can choose just one. You should use whichever way fits your trading style and whatever you need the most. The good thing is that everyone can use these breaker block concepts. They are very easy to understand, nothing complicated, and purely technical. You don't need to think about many things at once. But there is one thing that is very important, and that is bias. Bias plays a major role when using breaker blocks. In fact, bias is important in almost every concept I've taught you. You can use any ICT concept. You can do everything perfectly on the chart. But if your bias is wrong, everything will go against you. That's why you must always have a clear bias in your mind before using breaker blocks. If you don't know how to find your bias, you can watch my video on bias. It's very helpful and very different from what most traders teach. It's also much easier compared to what you'll usually find on YouTube. Now moving on. The first way you can use a breaker block is by using it as an entry confluence. This is the most basic way to use a breaker block, and this is how most traders use it. If you're new to trading and you've just learned what a breaker block is, chances are you've already been using breaker blocks like this. And there is nothing wrong with that. Using a breaker block as an entry confirmation is completely valid, especially for beginners. Now let me show you on the chart how you can use a breaker block as an entry confirmation in real market conditions. Here you can see that we first have a sell-side liquidity sweep. At the same time, our bias is bullish. If you look at the higher time frame, you can see that we have a 15-minute market structure shift to the upside. This tells us that price is likely to move higher, at least to some extent. Now, once liquidity has been taken, we move back to the lower time frame. At this point, most traders start looking for their entry confirmations. It can be anything they are comfortable with. Some traders look for a fair value gap, some look for an inverse fair value gap, and some use other confirmations. Any of those are fine. In this example, we actually have multiple confirmations available. But the key thing to notice is this. On the left side, you can see a bearish order block. Now, instead of wanting price to respect this order block and push lower, we want the opposite. Because our bias is bullish, we want price to push through this bearish order block and displace higher. We do not want rejection here. We want invalidation. And that is exactly what happens. Price pushes through the bearish order block with bullish displacement. At the moment this happens, the bearish order block gets inversed. Now this area becomes a bullish breaker block. Since a bearish order block has been disrespected, we now have a valid bullish breaker. From here, we can comfortably place our entry at this breaker block, keep our stop loss below the low, and manage targets however we prefer. You can target the highs. You can target an unfilled fair value gap. It doesn't really matter. What matters is the logic behind the trade. And as you can see, price moves very easily into our targets, respecting the breaker block exactly as expected. This is how you use a breaker block as an entry confirmation when your bias and context are clear. Now let me show you one more example, but this time a bearish example, so you can clearly see how breaker blocks work in both directions. In this example, you can see that we have a new week opening gap right here. Price comes in, fills the new week opening gap, and along with that, it also sweeps buy-side liquidity. On the 15-minute time frame, we now clearly have a buy-side liquidity sweep. This already gives us a bearish expectation, especially when combined with the higher time frame context. Now we move down to the lower time frame, for example, the 1-minute chart. Here, just before the liquidity sweep, you can see that price had formed a bullish order block. What we want in this situation is simple. Because our bias is bearish, we want price to displace through this bullish order block to the downside. Now let's see what actually happens. Instead of immediately displacing this order block, price pushes a little higher first, and then forms another bullish order block. So now we wait. What we want to see is price inversing this newly formed bullish order block. And that is exactly what happens. Price displaces through this new bullish order block with strength, and at that moment, this order block fails. Once it fails with displacement, it becomes a proper bearish breaker block. Now we have a very clean setup. Since we are looking for shorts, and this breaker block is formed in premium, we can comfortably place our entry at this breaker block. We place our stop loss above the high, and for targets, we can aim for the opposing side liquidity, since the bias is bearish. Now watch how price reacts. You can see how cleanly price respects the breaker block and moves straight into the lows. This is how you use breaker blocks as an entry confirmation in bearish conditions. I hope this example makes it very clear. If you have any doubts or questions about this, you can always reach out to me on Discord. The link is in the description. Now let's move on to the second way of using breaker blocks in your trading. The second way of using breaker blocks in your trading is by using them as targets. In this approach, there is nothing complicated. Instead of targeting opposing side swing highs or swing lows, we simply target unfilled breaker blocks that are sitting in premium or discount. The idea is very simple. You can plan your trade however you like. You align your trade with your bias, wait for proper confirmation, and execute the trade correctly. The only difference is at the time of placing your targets. Normally, most traders use a fixed risk-to-reward ratio or aim for opposing side liquidity, such as equal highs or equal lows. Instead of doing that, I suggest targeting unfilled breaker blocks that are positioned just below swing highs or just above swing lows. The reason for this is very important. Most of the time, price will move into those unfilled breaker blocks, fill them, and then reverse from that area. When this happens, price often moves back toward earlier targets or even into stop-loss areas. By targeting unfilled breaker blocks, you are often exiting your trade before the reversal happens, not after. This helps you protect profits and avoid giving back gains. Now let me show you some examples on the chart so you can clearly see how this works in real market conditions. For example, here you can see that we first have a buy-side liquidity sweep on the 15-minute time frame. Once liquidity is taken, the next step is to move down to the lower time frame and look for bearish confirmation. We allow price to form a few candles and observe how it reacts in this condition before taking any trade. In this example, you can see that we have two overlapping order blocks forming on the lower time frame. Now we can plan our trade. We place our entry at this order block, aligned with our bearish bias and confirmation. Now the most important part here is the targeting. If we drop further down on the chart, most traders would normally target these lows or the opposing side liquidity. But instead of targeting those lows, we are going to target the unfilled PD arrays. In this trade, we use this unfilled breaker block as our target. Now let's see what happens next. You can see that price moves directly into our target, which was the unfilled breaker block, and then reacts from that area. Notice something important. Price leaves these lows completely unmitigated. If you had targeted those lows instead, you would most likely have ended up at break-even or even stopped out. That is exactly why I always suggest targeting unfilled PD arrays, whether it is a breaker block or any other valid PD array. You can choose whatever PD array you are comfortable with. Now let's move on to the next way of using breaker blocks in your trading. We are going to use breaker blocks as our overall base for trading. In this method, you don't need a lot of extra confirmations. You don't need to stack multiple concepts together. All you need is a market structure shift and a breaker block. That's it. Using just these two things, you can define your bias and take high probability trades. The idea here is very simple. Market structure tells you the direction the market wants to move. The breaker block gives you the level where you want to execute. To define your bias, you only need to look at market structure. If structure shifts bullish, your bias is bullish. If structure shifts bearish, your bias is bearish. Once your bias is clear, the only thing you wait for is a breaker block in that direction. You don't need fair value gaps. You don't need extra indicators. You don't need complicated confirmations. Structure gives you direction. The breaker block gives you location. That combination alone is enough to trade. Now let me show you exactly how to use this approach on the charts. Let's move to the charts and break it down step by step. Now let me show you how you are going to use this approach in your trading step by step. As soon as you open the charts, the first thing you need to do is identify the most recent market structure shift. Whatever the last clear structure shift is, that is what you work with. In this situation, you can see that we have a bullish market structure shift. Once the structure shift is clear, the next step is to mark out the range of that structure shift. You simply mark the high and the low of the move that caused the shift. After that, because the structure shift is bullish, we are only interested in breaker blocks that are in discount. Here you can see our breaker block clearly sitting in the discount area of the range. Now we wait. We wait for price to retrace back into this breaker block. Here you can see price comes back and taps into the breaker block. Once the breaker block is tapped, we move down to a lower time frame to refine our entry. If we drop down to the 1-minute time frame, you can see that price sweeps sell-side liquidity inside the breaker block. This liquidity sweep gives us additional confirmation that price is reacting from the level. Now for confirmation, you can honestly use anything you are comfortable with and it will still work. But since this entire approach is based on breaker blocks, we are going to use a breaker block itself as our confirmation. Here on the lower time frame, you can see a breaker block forming. We place our entry at this breaker block, keep our stop loss below the low, and now we plan our targets. For targets, once again, we do not aim for random highs. Instead, we target unfilled breaker blocks. If we look above on the left side of the chart, you can see that in this previous leg, we have a bearish breaker block that is still unfilled. That unfilled breaker block becomes our target. Now let's see how price plays out. You can see how cleanly price moves straight into our target. After hitting the target, price then moves straight into our stop loss. And this is exactly why we always target unfilled PD arrays. We take our profits where the market is most likely to react, instead of holding and hoping for more. This is how easily price respects breaker blocks when market structure and context are aligned. So this is how you can trade using breaker blocks as a complete framework. You don't need to overcomplicate it. You don't need 10 confirmations. Market structure gives you direction. Breaker blocks give you location. When both are aligned, the trade becomes simple. If the market shows intent, you take the trade. If it doesn't, you stay out. Focus on clean structure, wait for price to come to your levels, and always target unfilled PD arrays. If you found this video helpful, make sure to like it, share it with someone who needs it, and subscribe for more content. If you want to connect with me, you can join my Discord and Telegram. All the links are in the description. If you want to learn privately from me, the mentorship link is also in the description. I've also left prop firm coupon codes down there if you're looking for those. That's it for this one. I'll see you in the next video.